A person earning $45,000 shouldn't use the same financial playbook as someone earning $200,000. And yet, every finance influencer on your feed is selling you the same 5 tips, the same generic advice, the same max out your Roth and chill energy. Here's the truth nobody tells you. The tax code is not flat. The opportunities at each income level are wildly different. The mistake that costs a person making $40,000 a year almost nothing can cost a person making $250,000 over $20,000 in a single year. So today, we're breaking down the optimal financial strategy at every income level in the United States, using current 2025 tax law. By the end, you'll know exactly which level you're on and exactly what your next move should be. Let's start at the foundation. If you're earning under $50,000 a year, the financial internet has lied to you. You've been told to budget harder, give up your morning coffee, and somehow invest your way out of poverty. That's not the strategy. The strategy at this level is leverage. Specifically, 3 forms of leverage the government and your employer are basically begging you to use. Move number 1, the Earned Income Tax Credit. The EITC is one of the most powerful tools in the entire tax code, and most people who qualify never claim it. For tax year 2025, the maximum credit is $8,046 for a worker with 3 or more qualifying children. Even with no kids, you can still pick up $649. This isn't a deduction, it is a refundable credit, which means if you owe nothing, the IRS sends you a check. File your taxes. Always. Move number 2, capture the 401k employer match. If your employer offers a match, contributing enough to capture it is the only guaranteed 100% return on your money you will ever see in your life. If your employer matches the first 4% of your salary, that's free money. Walking away from a match to pay down debt faster is one of the most expensive mistakes at this level. Capture the match first, always. Move number 3, build a 3-month emergency fund in a high-yield savings account. Not 6 months, not 12, 3. Because at this income level, the goal is not optimization. The goal is to stop bleeding cash every time the car breaks down or a medical bill hits. A 3-month buffer breaks the paycheck-to-paycheck cycle, and that single shift is what unlocks every other strategy in this video. That's level 1, foundation. Capture free money. Build the floor. Don't try to be clever yet. You crossed $50,000. Welcome to the leverage zone. This is where the tax code starts rewarding strategy, not just survival. 3 moves define this level. Move number 1, the Roth IRA. For 2025, you can contribute up to $7,000 per year, or $8,000 if you're 50 or older. The Roth IRA is the most powerful account in the American tax system for one simple reason. You pay tax on the money now, at your current bracket, and then it grows tax-free for the rest of your life. Every dollar of growth, every dividend, every capital gain, tax-free, forever. At this income level, your tax rate is probably 12% or 22%, which is historically low. You will almost certainly be in a higher bracket later. Pay the tax now, lock in the rate. Move number 2, the Health Savings Account, or HSA. This is the only account in the entire United States tax code with a triple tax advantage. Contributions go in tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses come out tax-free. 3 layers. No other account does this. For 2025, the contribution limit is $4,300 for self-only coverage and $8,550 for family coverage. You need a high-deductible health plan to qualify. If you have one, max it. And here's the secret most people miss. Don't spend the HSA. Invest it. Pay your medical bills out of pocket, save the receipts, and let that account grow for 30 years. It becomes the most tax-efficient retirement account you'll ever own. Move number 3, aggressive debt management using the avalanche method. Stack your debts by interest rate, highest first. Pay the minimum on everything else. Then take every spare dollar and throw it at the highest rate debt until it's gone. A credit card at 24% is a fire. A federal student loan at 5% is a slow leak. Put out the fire first. Mathematically, the avalanche always wins. The snowball method feels good emotionally, but if you can stomach the math, the avalanche saves thousands. Foundation, then leverage. Now we optimize. Cross $100,000 and the game completely changes. Suddenly, taxes are your biggest single expense. Bigger than rent, bigger than your car, bigger than anything else in your life. And at this level, 3 optimizations matter. Optimization number 1. Pivot from Roth to traditional contributions inside your 401k. At lower income, you wanted to pay tax now. At this level, you probably don't. As a single filer in 2025, you cross into the 24% bracket at $103,350 of taxable income. Every dollar you push into a traditional 401 at 24% saves you 24 cents of federal tax today. The 2025 contribution limit is $23,500. If you max it at the 24% bracket, that's roughly $5,640 in federal tax savings in a single year. Real money. This is where the wealthy quietly pull ahead. Optimization number 2, the backdoor Roth. Once your income climbs into the high 100s, you start to phase out of being able to contribute directly to a Roth IRA. For 2025, the phase-out for single filers begins at $150,000 and ends at $165,000. Above that, the front door is closed, but the back door is wide open. You contribute to a traditional IRA, then immediately convert it to a Roth. Perfectly legal. The IRS published it. Just be aware of the pro rata rule if you have other pre-tax IRA balances. Optimization number 3, and this one is psychological, not technical. The lifestyle inflation trap. At $150,000 a year, you can afford a nicer car, a bigger apartment, restaurant dinners 4 nights a week. And the trap is that almost everyone takes the bait. Your raise becomes your new minimum. The single most powerful move at this income level is freezing your lifestyle for 2 or 3 years after a raise and routing the entire delta into investments. That's how a 6-figure earner becomes a millionaire by 45. Not the salary, the discipline of not spending the salary. Above $250,000, you are no longer playing the same game. The tax code starts treating you as a high earner. Additional Medicare surtaxes kick in, and the rules get more complex. But the opportunities also get bigger. 3 advanced strategies define this level. Strategy number 1, tax loss harvesting. Inside a regular taxable brokerage account, when an investment drops below what you paid for it, you can sell it, lock in the loss, and use that loss to offset capital gains elsewhere. You can also offset up to $3,000 of ordinary income per year. In a high volatility market year, a strategic harvest can save a high earner $5,000 to $15,000 in taxes without changing their overall portfolio one bit. Just watch the wash sale rule. You cannot buy back the same security within 30 days. Strategy number 2, the mega backdoor Roth. This is the most underused weapon in the entire American tax code for high earners. If your employer's 401k plan allows after-tax contributions and in-plan Roth conversions, you can stuff additional money into the plan beyond the standard $23,500 limit. The total combined limit, including employee, employer, and after-tax dollars, is $70,000 in 2025. That can mean tens of thousands of additional dollars per year flowing into a Roth account, growing tax-free forever. Ask your HR department if your plan allows it. Most high earners never even check. Strategy number 3, understand the alternative minimum tax. The AMT is a parallel tax system designed to make sure high earners with lots of deductions still pay something. For 2025, the AMT exemption is $88,100 for single filers and $137,000 for joint filers, with phase-out starting at $626,350 and $1,252,700 respectively. If you exercise incentive stock options, hold large amounts of municipal bonds, or have unusually high deductions, you may trip the AMT. At this level, you do not file your own taxes. You hire a CPA. The fee is rounding error compared to what they'll save you. So here's the recap. Under $50,000, capture the EITC, capture the match, build a 3-month emergency fund. $50,000 to $100,000, Roth IRA, max the HSA, kill high-interest debt with the avalanche. $100,000 to $200,000, pivot to the traditional 401k, use the backdoor Roth, freeze your lifestyle. Over $250,000, tax loss harvest, weaponize the mega backdoor Roth, hire a CPA, and respect the AMT. The biggest mistake people make in personal finance isn't picking the wrong stock. It's using a strategy meant for the wrong income level. Match the strategy to the level. That's the whole game. If this helped you figure out which level you're on, like and subscribe. I'll see you in the next one.